Hi, Professor. So today we're going to be talking about bond valuation. Um, so first sorry, we have the bond characteristics. We have bond A and bond B with the same credit ratings, par value, and coupon rate. Their only difference is their maturity, which is 30 years for bond A and 5 years for bond B. Bond B will generally trade at a higher price in the market compared to bond A, primarily because it has a shorter duration and thus less exposure to interest rate risk. Investors prefer the relatively safety of the short-term bond, making them willing to pay premium for bond B's reduced risk profile. For impact on interest rate risk, when the interest rates in the economy go up, the market price of both bond A and bond B will decrease. However, bond A with its 30-year maturity period will experience a more significant price drop compared to bond B, which has only 5 years. This is due to bond A's higher sensitivity to interest rate changes, stemming from its longer duration. For example, let's assume both bonds have a par value of $1,000 and a coupon rate of 5%. And if the market rate increases to 6%, bond A with a 30-year bond will have a significantly lower price than $1,000. And using the same formula for bond B, for 5 years, the price will be lower than 1,000%, but not as much as bond A. For the percentage price change. Bond A, with its longer duration and 30 years maturity, will experience a higher percentage price change compared to Bond B, which has a shorter duration when interest rate goes up. This greater sensitivity to interest rate changes make Bond A more volatile and subject to a larger percentage price swings in response to the changes in interest rates. Here we can see an example. If price of bond A decreases from 1,000 to 800, the percentage change is $20. And if the bond B's price drops from 1,000 to 950, the percentage change is 5% only. So bond A has a higher percentage price change. So if there is a slowdown in economy over the next 12 months, I would consider bonds with a shorter duration. It reduces sensitivity to interest rate changes, making the portfolio less volatile in uncertain economic conditions. Uh, to invest in high quality bonds, which mitigates increased credit risk during economic slowdowns, ensuring more reliable returns and a lower default risk. Considering treasury bonds, these are safer investments which with virtually no default risk, providing security and stability in a downturn. And lastly, bond ladders, which spreads investments across various maturities, balancing the risk and liquidity and allowing reinvestment opportunities as the bonds mature. And this here we have the summary of everything that we went through in this presentation. And here are my references, which are two of our course books. Thank you.